In 2002, one of the largest telecommunications companies in America admitted that billions of dollars in expenses had been hidden from investors. The method was not a futuristic computer hack, it was not an offshore maze, and it did not require an elaborate secret business. WorldCom took ordinary costs and gave them a different accounting label. Expenses became assets, losses disappeared, profits appeared. For a while, the trick helped a weakening company look healthy. Then a small internal audit team began asking questions that senior executives did not want answered. This is the story of WorldCom, how relentless growth, pressure from Wall Street, weak oversight, and a basic accounting manipulation helped bring down a corporate giant. Part 1. Building a telecom empire. WorldCom began in 1983 as long-distance discount service. The company entered a telecommunications market that was changing quickly. Long-distance calling was becoming more competitive, and smaller providers saw an opportunity to challenge the established giants. Bernard Ebbers became chief executive and pursued growth aggressively. Instead of building the company slowly, WorldCom expanded through acquisition after acquisition. The strategy worked while investors rewarded rapid growth. Each deal made WorldCom larger, increased reported revenue, and gave the company another story to tell Wall Street. Its defining transaction was the acquisition of MCI, a major long-distance carrier. WorldCom became a global communications powerhouse serving consumers, businesses, and government customers. But acquisition-driven growth creates a dangerous expectation. Every quarter must be bigger than the last. When the telecommunications boom weakened and competition increased, WorldCom's underlying performance began to deteriorate. Revenue growth slowed, costs remained high. The company risked missing the earnings expectations followed closely by analysts and investors. WorldCom had reached the moment that reveals the character of a company. Management could tell investors that conditions had changed, or management could change the numbers. Part 2. The pressure to hit the number. One of WorldCom's biggest expenses was known as a line cost. WorldCom often had to pay other telecommunications companies to carry calls or provide access to their networks. These payments were part of operating the business. Under normal accounting rules, they belonged on the income statement as current expenses. That matters because an expense reduces profit immediately. As WorldCom's business weakened, its line costs made the decline visible. The company could no longer produce the results Wall Street expected through normal operations. According to the Securities and Exchange Commission, senior management responded by manipulating the accounting. The company first used reserves to reduce reported expenses. When that approach could not continue, the scheme shifted. WorldCom began transferring portions of its line costs from expense accounts into capital asset accounts. To understand why that was so powerful, imagine a business spends $1,000 on this month's electricity. If the payment is recorded correctly as an expense, this month's profit falls by $1,000. But if the company falsely calls that payment an asset, most of the cost does not hit the income statement immediately. The company appears to own something valuable that will benefit it in the future. The cash is still gone. The bill was still real, but the reported profit looks much better. WorldCom used this basic idea on an enormous scale. The false entries reduced expenses by hundreds of millions of dollars at a time. Reports sent to investors made the company appear profitable when it was suffering large losses. The accounting did not repair the network business. It did not create customers. It did not improve cash flow. It only delayed the truth. Part 3. Hiding the decline. The fraud was especially dangerous because WorldCom was not a small, unknown company. It was a major public corporation followed by analysts, audited by outside professionals, and overseen by a board of directors. Yet, the internal controls were weak enough for unsupported entries to move through the financial system. The company's own investigative report later described more than $9 billion in false or unsupported accounting entries from 1999 through 2002. It also described a culture shaped by pressure from senior leadership, inadequate controls, and failures in corporate governance. That culture is important. Large frauds are rarely caused by one journal entry alone. They survive because people become afraid to challenge authority, unusual requests become routine, and hitting a target becomes more important than reporting reality. Once a company crosses that line, each reporting period creates a new problem. The old false numbers become the baseline. The company must create even larger false numbers to preserve the appearance of growth. The deception becomes harder to stop because admitting the truth also means admitting that the earlier reports were false. Part 4. The internal audit team. The collapse began when WorldCom's internal audit group started examining suspicious accounting activity. The team was led by Cynthia Cooper, WorldCom's vice president of internal audit. Cooper and her colleagues followed entries that lacked convincing support. They examined the company's capital expenditure accounts and questioned why ordinary network costs were being treated like long-term assets. The work placed them in conflict with powerful executives, but the numbers did not make sense. The team continued investigating, sometimes working late to avoid interference. They traced billions of dollars in improper transfers and brought the findings to WorldCom's audit committee. On June 25, 2002, WorldCom announced that approximately $3.85 billion in line costs had been improperly transferred into asset accounts during 2001 and the first quarter of 2002. That was only the first major disclosure. Further investigation uncovered billions more in improper accounting. The company's investigative committee later reported more than $9 billion in false or unsupported entries. Broader summaries of the scandal commonly describe approximately $11 billion in misstatements. The scale was historic, but the discovery came from a small group that refused to accept an unsupported answer. Part 5. Collapse and consequences. The market's trust disappeared. Less than 1 month after the first announcement, WorldCom filed for Chapter 11 bankruptcy protection in July 2002. At that time, it was the largest bankruptcy filing in United States history. Employees lost jobs. Investors suffered enormous losses. Retirement savings tied to WorldCom stock were damaged. Customers and government agencies had to consider whether the company could continue providing essential communications services. The legal consequences reached the top of the company. Former Chief Financial Officer Scott Sullivan pleaded guilty and cooperated with prosecutors. Former Chief Executive Bernard Ebbers was convicted of conspiracy, securities fraud, and making false regulatory filings. In 2005, he was sentenced to 25 years in prison. WorldCom itself eventually emerged from bankruptcy under the MCI name. Verizon acquired MCI in 2006, and parts of the old WorldCom network became part of Verizon's business operations. The corporation survived in a different form. The original trust did not. Part 6. What the case teaches. The WorldCom scandal leaves several lessons. First, revenue growth can hide operational weakness. WorldCom became famous through acquisitions, but buying companies is not the same as building a healthy, integrated business. When the deal-making slowed, the pressure on the underlying operation became harder to hide. Second, accounting labels can change the entire story investors see. An expense and an asset are not interchangeable. An expense reflects value consumed now. An asset should provide a future economic benefit. Moving a cost between those categories can transform a loss into a profit without changing the real business at all. Third, corporate culture is an internal control. Rules and audit procedures matter, but they fail when employees believe that questioning senior leadership will end their careers. A company that punishes bad news creates a market for false good news. Fourth, internal audit must remain independent. The WorldCom team succeeded because it kept following the evidence and had a path to the audit committee. Internal audit is not just a compliance function. It can be the last defense protecting employees, investors, and the company itself. Finally, a business cannot solve an operating problem with accounting. WorldCom's false entries bought time. They did not fix declining performance. Every quarter of concealment made the final collapse more destructive. Closing WorldCom's fraud was measured in billions, but the central trick was simple. The company took expenses that should have reduced today's profit and presented them as assets that could be spread across the future. For investors, the statements showed strength. Inside the business, the decline continued. And when a small audit team finally connected the entries, one of America's largest corporations fell into bankruptcy within weeks. The lesson is not only to watch the size of a company's profits, it is to ask how those profits were created. If you enjoy true stories about corporate fraud, financial failure, and the decisions that destroy major companies, subscribe to the Case Study Lab. For more case studies and premium reports, visit https://fmaslim.github.io.